18%. Keep that number in mind, because it's more than just a statistic, it's a statement. In a world dominated by trade wars, tariffs, and constant geopolitical maneuvering, 18% is the emergency exit President Donald Trump just forced open. While the rest of the world was trying to lock the doors on Washington, Trump swung them wide. Just days ago, we were all witnessing what seemed like a diplomatic disaster. The European Union and India had signed a historic deal, what they called the mother of all deals, a massive free trade agreement designed to eliminate tariffs entirely. Meanwhile, Canada and China were quietly strengthening their own economic ties. And then there was the United States, under Trump's hardline tariff approach, looking isolated, like the odd one out at the global trade table. But never, ever underestimate the survival instinct of a leader who sees every deal as a personal battle. In an unexpected move that sent shockwaves through Europe and Asia, Trump launched a direct counterstrike. On Monday morning, he announced a cut in tariffs on India, down from 25% to just 18%. And he didn't stop there. The additional 25% tariff on Indian oil purchases from Russia was gone as well. That 18% tariff wasn't just a number, it was a bold signal, a shot across Europe's bow. Trump was telling the world, you can spend decades negotiating to zero out tariffs, but I can change the global rules with one phone call. And the response from the markets? Lightning fast. India's Nifty 50 index shot up by 2.5%. The rupee, once Asia's worst performing currency, suddenly surged, hitting 90.26 against the dollar. This wasn't just a minor recovery, it was a massive relief rally. Analysts at Geopolitical described it as the clearest proof yet that Trump is playing a high-stakes game, walking and chewing gum at the same time, keeping his focus on economic priorities despite the noise of global tensions. So, why all the excitement? Why did the markets react so enthusiastically to 18%? The answer lies in competition. At this rate, Indian goods entering the U.S. now have a distinct advantage over regional competitors like Pakistan, with a 19% tariff. Vietnam, 20%, and Bangladesh, 20%. Trump was essentially offering Prime Minister Modi a straightforward deal. Choose me and you win. The payoff? A staggering $500 billion in U.S. goods from energy to technology, agriculture to coal, pouring into India's economy. It was a $500 billion shot in the arm for the American economy during a time of growing isolation. But make no mistake, this is a high-stakes gamble. Trump has shattered traditional diplomatic protocols, bypassing years of expert negotiations to deliver an almost instantaneous economic shakeup. But the real question is this market euphoria sustainable? Or is 18% just a temporary fix masking a deeper fracture within the Western alliance? We're only at the beginning of this new era of interdependent trade, and right now, 18% is the number on everyone's mind. It's been dominating the headlines from Washington to New Delhi. But here's the thing. There's a massive difference between a trade deal carefully negotiated by thousands of experts over the course of a decade and one that's signed off by two leaders over a single phone call. What we're seeing here is the purest example of what Washington calls the power of the signature. Let's break down the numbers. India is now committed to buying $500 billion worth of U.S. goods, everything from energy and technology to agriculture and coal. To put that in perspective, this figure is more than double the current total trade volume between the two countries. This isn't incremental growth. It's an economic revolution written on a sticky note. In exchange, India gets the lowest tariff rate granted by the U.S. to any major manufacturing nation in the region, 18%. That's lower than Pakistan, lower than Vietnam, lower than Bangladesh. Trump isn't just lowering tariffs. He's essentially creating a special economic zone for India right within U.S. borders. But before we get swept up in the headlines, let's take a step back. Evan Feigenbaum, a renowned expert in international trade at the Carnegie Endowment, has a stark warning. The devil, as they say, is in the details. And when you start looking at those details, the cracks begin to show. Feigenbaum is highly skeptical of that $500 billion figure. He calls it a stretch, a polite way of saying it's more fantasy than reality. Think about it. How does an economy absorb hundreds of billions of dollars in additional goods without the corresponding infrastructure to support it? And then there's the elephant in the room, Russian oil. Trump claimed that India would stop buying oil from Russia, a major part of the deal. But if you look closely at Prime Minister Modi's statements on social media, he says nothing about halting Russian oil purchases. Feigenbaum predicts that India will never make a clear commitment to this. And for good reason. India relies heavily on cheap Russian oil to feed its economy. Let's look at the bigger picture. Despite this flashy new deal, India and the U.S. have been long-time trading partners. Total trade between the two nations rose by over 8% in 2024, reaching $212.3 billion. Exports of U.S. goods to India climbed to $41.5 billion, while services exports surged 16%. So the real question is, why did Trump need such a high-profile, seemingly unrealistic deal in the first place? The answer, ladies and gentlemen, isn't purely economic, it's symbolic. Trump needed to prove that he could pull India back from Europe's orbit, that he wasn't isolated. But as market enthusiasm fades, investors will begin to look at the fine print. If India doesn't buy the full $500 billion worth of goods, or if Russian oil continues to flow into Mumbai, will that 18% tariff disappear as quickly as it appeared? The power of the signature can create market surges in an instant, but to sustain that momentum, you need more than a pen. You need a reality that adds up. Right now, Trump's version of the math and Feigenbaum's version are operating in two completely different universes. Now, let's take a closer look at what India has been enduring until now. Under Trump's previous policies, India faced a staggering 50% total tariff. Why 50%? Well, it wasn't just a standard 25% reciprocal tariff. Trump added another 25% penalty on India for continuing to buy Russian oil. It was like getting two tickets for the same offense, one for being in the wrong lane and another for the color of your car. But now, that massive tariff burden has been wiped away and replaced with a single 18% rate. But the real question is, why 18%? Why not 15 or 17 or just 0, like the deal with the European Union? The answer is part of a highly sophisticated geopolitical strategy. By setting India's tariff rate at 18%, Trump isn't just easing Modi's burden, he's picking the winner. He's sending a direct message to the factories in Shenzhen. Don't move to Vietnam, move to India. Trump wants India to become the new factory of the West, but he wants it on his terms, not Europe's multilateral terms. This is where confidence building comes into play. India has been hesitant about embracing the U.S. after Trump's sanctions and harsh rhetoric in recent months. But this deal is designed to rebuild that confidence. According to veteran trade official Mark Lynn Scott, this agreement is a confidence-building measure. It's Trump's way of signaling that the U.S. is still a reliable partner for India in the long run. But let's flip over to the other side of this deal. While this new arrangement sounds promising, the fine details still need to be ironed out. As it stands, the deal is more of a framework than a binding contract. It's like promising to get married without discussing who pays the rent or who buys the groceries. For all its symbolic significance, massive legal questions remain about whether Trump has the authority to finalize a deal without Congress's approval. This deal with India carries greater strategic weight than the European Union's free trade agreement. Why? Because the U.S. is the anchor. The deal with India is a way to stabilize India's position within the Western supply chain, preventing it from drifting too far into Beijing's orbit. Trump's use of 18% to secure this deal with India isn't just about trade. It's a strategic anchor that ties India closer to the West, ensuring it won't become an adversary in the global chess game. But don't be fooled, India is still playing a delicate balancing act. Prime Minister Modi has made it clear that while India is willing to deepen ties with the U.S., it's also seeking to maintain strong relations with Russia and China. In fact, in the wake of this deal, Modi has been eerily silent about cutting ties with Russia over oil purchases. India is trying to keep both sides happy, and that's a game fraught with risks. The real test for Trump will come when the fine print begins to unravel. Will India truly commit to buying $500 billion worth of U.S. goods? And more importantly, will it keep its distance from Russia's cheap energy supplies? Those questions remain unanswered, and the clock is ticking. So, what does all this mean for the global economic landscape? On the one hand, India's new 18% tariff provides a much-needed boost to its economy. It's already causing a market surge, with the Nifty index jumping nearly 5%. Indian textile, footwear, and specialty chemical stocks are seeing huge gains. U.S.-based companies like iPhone manufacturers, Infosys, and Wipro are all benefiting from the favorable tariffs. For investors, this is a much-needed relief after a rough 2025, when $22 billion in foreign capital fled the country. But the story isn't all rosy. For U.S. consumers, don't expect an immediate drop in prices at your local grocery store. While the new tariff cut is a win for Indian businesses, importers typically pocket the savings from tariff reductions rather than passing them on to consumers. For many American households, the cost of living crisis remains. And in India, the situation is even more complex. Small farmers are already voicing concerns about the open market for U.S. agricultural goods. With tariffs now at zero, cheap American produce could flood the market, drowning out local agriculture and threatening food security. This isn't just a stock market story. It's a story about the delicate balance between global markets and the realities of everyday life. The question is, how will both countries handle the social and economic consequences of a deal that's more symbolic than practical? In the end, 18% may seem like a magic number. It's a victory for Donald Trump, but for the ordinary citizens in both countries, it might not be as simple as it seems. The $500 billion figure is a promise, but it's one that lacks the legal binding force to make it stick. The tariff cut is a short-term win, but will it last? Will India really open its markets to $500 billion in U.S. goods? And will Russia remain a silent partner in the background? The truth is always in the details, and in this case, the fine print may tell a different story than the headlines suggest. For now, investors are riding high on the wave of market sentiment, but the real test will come when the full implications of this deal unfold. The battle for India's economic future isn't over. It's only just begun.